What is up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we're going to be taking a look at shares of Oracle. They have experienced a sell-off recently, so I do feel it's important for us to take a look at a few fundamental and technical valuation metrics to see and determine if shares are at a good entry point today. As always, this video is not investment or financial advice and is solely for entertainment purposes. So let's dive right in here to the past 12-month price performance of shares of Oracle. You can see that within that time frame, shares have actually underperformed the Nasdaq over the past year by 57.3%. On a year-to-date basis, shares are down 22%, whereas the Nasdaq itself is up 13.7%. On a 1-month basis, we've seen a rally in the shares, which has caused an outperformance of the benchmark by almost 11%. Now, I want to just mention that sell-off that you see really from the beginning of June. There's been a variety of factors. The long-standing argument for the past 6 to say 18 months of Oracle taking on too much debt, $160 billion to be exact, whether you're looking at the Michael Burry short. But I do believe the main reason for the sell-off was the energy transfer subsidiary Transwestern Pipeline, which announced a delay in its Green Chile project natural gas pipeline, pushing the start date from August 2026 to February 2027. This pipeline is critical to supplying power to Oracle's largest AI data center in New Mexico, and this fuels anxiety over the data center operational timelines and completion dates. When Oracle is taking on so much debt, and Oracle is not alone to this, any company that takes on too much debt, they are really levered to execution risks. And when you have an execution delay or an operational inefficiency, you do see very big sell-offs in the name just due to the very large leverage that Oracle has taken on by tapping the debt markets to finance a lot of this data center build out and growth, which I do believe over the long term will pay dividends to the company and shareholders as a whole. But when we keep looking at that top chart there, you do see really from the start of the year, shares trading in a downward trajectory. You see that green line, which is the 50-day moving average, cross below the 200-day moving average in the orange line, which does indicate a technical long-term sell signal. Really, through the beginning of June of this year, we did see shares rally significantly and start to trade above both moving averages, which did have that gap of the 50 and 200-day moving average narrow. We are seeing shares continue to appreciate as of the past few weeks. If this continues, we should see shares trading above both averages, seeing that gap between the 50 and 200-day moving average continue to narrow, and potentially have that 50-day moving average cross over the 200-day moving average, which does indicate a technical buy signal for long-term investors. And there's a few key points I want to point our attention to here. Just look at that bottom left. You see that earnings per share really growing by almost 50% from now through 2027, going from $7.63 a share to $10.94 a share. I do believe that's being conservative, especially with the heavy spending that Oracle is doing fundamentally. And yet, when we see all this cash flow being spent towards servicing debt, Oracle has actually increased their dividend. We'll see that in later snippets in this video. But Oracle is currently having a 1.3% dividend, which coincides to a $2 per share dividend on an annualized basis. You are seeing those sales numbers over the past 12 months in the bottom right, improving 17.4% over the past 12 months. And when we look at those profitability metrics, yes, through 2023, we have seen margins actually come down, yet they're still above the industry and benchmark average. Look at that gross margin of 63.3%, industry average of 56.5%, and the benchmark of 28.1%. Yes, you are seeing those margins compress just due to the heavy investment that Oracle is doing in the underlying fundamental business, but those investments are actually starting to be realized and are improving operational efficiencies when we see those net margins in that 10-year trend really starting to creep up. Even in that case, not back to where they were in 2020 and 2021 net margins, yet they are still above the industry and benchmark averages at 25.4%. And again, with all that heavy CapEx spending in improving their ecosystem, building out the AI cloud infrastructure that's needed to support the AI networks, the return on equity is still 54.3%, more than double the industry and more than 4x the benchmark average. Very good profitability metrics. even taking into effect the large spending and debt servicing that Oracle has needed to do. And when we look at all those quote unquote negative headlines, which are really not corresponding in their profitability metrics, valuations are below their 5 and 10-year averages. When we look at that forward PE of 17.6, the not so important trailing PE of 26.1, even that price to sales at 6.6, the 6.6 price to sales is higher than what we want to see. But I do believe with the premium offerings that Oracle has and the importance that Oracle has in the whole AI ecosystem warrants a premium on the price to sales. But even that forward PE of 17.6 is in value, in some cases, deep value territory. And there are 39 analysts who cover Oracle shares. They have an average price target of $249.59, which implies shares appreciating by almost 60%. The biggest bear on the street has shares depreciating by almost 30% at $110 a share. I will mention their 52-week low was $114.50, which was touched really towards the end of July. And even in that case, the biggest bear did not revise down their price target. In fact, no analysts have revised down their price targets over the past couple months. And when we look at the biggest bull on the street, their price target is $400, which implies a 156% appreciation in shares. And when we look at that top graph there, 45 ratings on the name, the red bar, which indicates our sell ratings, is at a 12-month low. Shares in the blue line are at a heavy discount to that dotted line, which is the analyst average price target. So at some point, like we've seen in months and years past with Oracle, there will be a compression, whether that is a revision downward in analyst target prices, which has not been the case recently, or which I feel is the case, will be a share appreciation to get back to its true intrinsic value. Again, like I was saying earlier, on every single valuation metrics that you're looking at on this screen, if we look at that 5-year average column and cross-reference that with the current column for valuation metrics, in each one of these, the current valuation of Oracle shares is trading well below their 5-year averages with an improved offering and better runway for growth long term for the underlying business. And when we look at that and compare it to its peers, I've touched on in previous videos about Microsoft, and I encourage you guys to go take a look at those videos. I don't believe it's a fair comparison just because Microsoft has a larger product offering and is able to have pricing power to improve their profit margins. A good comparison is IBM. I'm not going to compare Workday and Salesforce in this case because they aren't really in the same business as Oracle. In fact, if you ask Workday and Salesforce what they actually do, I don't think they can tell you, in all honesty, what they do to begin with. But IBM does have that, what we'll call a Fed put in place due to the quantum computing slush fund by the Trump administration. For a lot of quantum computing names, IBM is not alone. Rigetti Computing is another name in that space. But when we look at these two companies side by side, Oracle and IBM, on a forward basis, Oracle is trading at much cheaper valuation metrics than IBM with better operational efficiencies and underlying business than IBM. Look at those gross margins, operating margins, net margins, return on assets, equity for Oracle compared to IBM. It is almost no comparison. You got to ask yourself which company you would like to own. I believe IBM is also a good company that is very important in the next phase, especially in quantum computing and the boom that we've seen in popularity of quantum computing names. IBM, I believe, long term will still be a good company. But when I have to compare Oracle to IBM and which company I would like to own, personally, I would prefer Oracle over IBM, especially with the need of Oracle's cloud and AI cloud infrastructure for AI models. And we look at those profitability metrics, like I was saying earlier, in 2023, you did see a compression of margins. That was just due to the heavy investment and start of the heavy capex of all hyperscalers. Oracle is not excluded from this. They are a technology company that needs to continuously invest in their underlying business to continue to grow and be a step ahead of their future competitors. But gross margins have come down, still at a very healthy 63.3%. net margins have continued to creep up over the past few years, which does indicate that the investments management is making is allowing for margin to expand and continue to expand, especially when input costs globally in this sector have continued to rise really since the start of the Ukraine war. And when we look at those return on assets, equity, total capital, invested capital, yes, take a look at that return on equity in May of 2021 at 158.8%, now to 54.3%. That is a significant drop, yes, but a 54.3 return on equity by any standard is very healthy as well. And you're seeing those being compressed. Like I said, Oracle has tapped $160 billion in debt to finance their future growth, which inevitably will, in the short term, compress margins. Let's see long term. Time will tell if these investments will pay off. We are starting to see that. And we're also seeing that in operational efficiencies with revenue and net income per employees continuing to rise and steadily rising over the past 5 and 10 years that we see in the bottom half of that snippet. And sales and revenue have been healthily growing over the past 5 and 10 years. Look at these 5 and 10-year compound annual growth rate numbers across the board. Very healthy to see. 11% on 5-year CAGR, net income continuing to increase over a 5 and 10-year compound annual growth rate. Earnings per share continuing to grow as well. I will mention that these earnings per share have been heavily compressed and held back due to the heavy capex of Oracle's management over the past few years. And with all that cash, what is management doing with all that cash? Like we've seen in the past, share repurchases have been a big part of Oracle's big price momentum. Dividends have steadily increased over the past few years. But I will mention the looming debt servicing that Oracle has needed to take care of. As you can see in that graph visually at the top, that blue bar is the cash and short-term investments. There's significant more cash on the book to continue to service this debt, and they are still having a backlog of revenue on their cloud space, which allows them to continue to service this debt over the short and medium term. And now we like to ask ourselves, where is all that cash generated from? Well, here's a few different segments for Oracle's underlying business. You can see cloud and software making up the largest percentage of revenue for Oracle. See that cloud growing 60.1%, continuing to trend. You're seeing in those bar graphs there the quarterly trends over the next 3 years. Cloud, software, and software support and cloud infrastructure will be the largest growth drivers for Oracle over the coming quarters. And these are very high margin businesses. They are investing heavily right now to potentially have that boom in demand and boom in revenue and hopefully expanded margins in the coming quarters and years to come. But this is what we want to see as shareholders. The sales are going to be coming from high margin businesses, which allow margins to continue to expand over the long term. And we have seen that over the past few years of net margins continuing to creep upward back to where they were pre CapEx spend. And this is just an important snippet I wanted to put in here. I hear a lot of people talk about the geographical breakdown of Oracle's revenue really being saturated in the US and coming down globally, which is the case. You are seeing those year over year changes, and even those 3-year trends you see in those lines there on the right hand side of the snippet, all trending downwards in the wrong direction. I will preface that by saying the nature of Oracle's business means they must be with the largest technology players. And where are those largest technology players situated? They are currently in the US, whether that is Meta, Microsoft, Alphabet, Amazon. You're having the OpenAIs and the Anthropics of the game, all needing Oracle's services, and they are all situated and headquartered in the US. So having that US revenue make up almost 2/3 of that $67.4 billion of revenue over the past 12 months is not a concern of mine, especially considering this is where the largest hyperscalers are, allowing Oracle to continue to capitalize on the global and more specific US spending on AI. Now, throughout this video, you have heard me discuss a lot about the bearish points, whether it's the Michael Burry short, the $160 billion of debt servicing that Oracle needs to maintain, or the natural gas pipeline delay in their New Mexico facility. I believe it's important for us to actually take a look at the bullish points for Oracle over the short, medium, and long term. And I'll start with the rapid growth in Oracle Cloud infrastructure. This has emerged as a preferred cloud provider for training and deploying large language models and generative AI applications. In its second generation architecture, Oracle Cloud offers high bandwidth, low latency RDMA networking, making it cost effective and efficient for compute heavy AI training compared to legacy cloud providers. High demand for AI compute capacity has led to significant growth in remaining performance obligations, and backlog demand continues to outpace available capacity, signaling long term pipeline visibility for this segment of Oracle. And this is what I was talking about earlier on, where we saw that 60.1% growth year over year in Oracle Cloud. They still have that backlog, and I do believe that they're able to capitalize on that backlog long term, which we should see revenues expanding and margins expanding, as that is a very high margin business for Oracle. And Oracle has aggressively expanded cross cloud integrations via partnerships like Oracle Database at Azure and native integrations with AWS and Google Cloud. These deals allow joint customers to run Oracle databases natively within rival public cloud providers, allowing Oracle to capture database migration workloads that previously hesitated to move off premises. And Oracle's legacy enterprise database software and enterprise suites, such as Fusion and NetSuite, form the operational backbone of thousands of Fortune 500 companies and government organizations. Transitioning these legacy on premise workloads to Oracle Cloud applications ensures predictable, high margin SaaS recurring revenue with low churn risk. And having the ability to do that in such a high margin business allows margins to continue to expand in the coming quarters and years ahead. So these are all bullish points that we want to see. And Oracle is a very important provider of cloud capacity for enterprises and large language models. Again, this is not investment or financial advice. This is just my personal opinion. Let's see how this investment plays out. Only time will tell. But I do appreciate you guys making it to the end of this video. Please do hit that like and subscribe button and stay tuned for the next video.